Going to run through some of the current things, cycles and seasonal patterns, and other analyses that we're looking at right now. We have a interesting year here with the pre-election year, with the Fed no longer pumping money into the market and talking about perhaps increasing rates, while the market continues to leak higher in the face of some unsavory things going on around the world. So before we get into that, just a quick word from my lawyers. Just typical disclosure, past performance is not a guarantee of future results, not a solicitation to buy or sell anything. Do your own due diligence, consult with your own advisors, etc., and so forth. So just a quick announcement, the website, stocktradersalmanac.com, and our service, digital subscription service, Almanac Investor, is now back under our management. It had been being run by Wiley for many years. They still publish the Stock Traders Almanac printed book. So we're pleased to have control of that, and there'll be some enhanced services as we move forward. And in honor of that, here's a look at the new website just to give you an idea. My sort of balding mugshot up there. Maybe somebody has some hair replacement treatments they can send me. So again, we're looking to make things more simple and easy to get a hold of, and provide additional information and trading guidance, and better service than we were getting in the previous site. So we're excited about that. So with the temperatures quite cold up here, we have an offer out there, 20% off of our annual subscription rate of $179.95. The code is frigid20, and it comes with a free copy of the 2015 Stock Traders Almanac, which sells for $50 in the stores. So you save about $86, and you get a free almanac, and you get to see all of the trade and investment suggestions, ideas, and market analysis from us. So you can go to stocktradersalmanac.com and use that code frigid20. As you heard in my intro, I am newly allied with a mutual fund company called the Probabilities Fund, which I think is a fantastic name. And what they've done there is they've taken most or a lot of the strategies that are in the Stock Traders Almanac, and created a mutual fund. They're looking into doing an ETF with it as well, but it's a tactical long-short U.S. equity strategy fund. And including some other wrinkles that they've added, the fund, which I'll show you later, has outperformed the S&P 500 since inception in 2008 by about 154% to 64, roughly. So you can do as a lot of people do, use the almanac and the different cycles and seasonal patterns and strategies and other technical and fundamentals that I use as well, and do it yourself, or you could put yourself or clients into some of their assets or your assets into this mutual fund, and it's got a very low correlation to the S&P. It's a great hedge against the market. And they've also got a sector rotation fund in the work, using a lot of the sector seasonality work that we've done over the years. So I'm going to give you a little look at my outlook with respect to the pre-election years, and we'll look at some of the interesting oil and gas sectors, the oil and gas sector play that's coming, around the calendar right now, in conjunction with a sizable correction and pretty much a bear market in oil. The fact that we had this rough January being shaken off, and a look at how we sort of look at the market all the time at a glance, 5 different categories, and the fact that we may be changing the Fed's position right now, though they seem to be remaining quite dovish. So we have a basic philosophy. You may know the George Santayana quote that those who those who fail to remember the past are condemned to repeat it, and we believe that those who study market history are bound to profit from it. We've been doing this for about 48 years. The Stock Traders Almanac is currently in its 48th publication. The 2015 is the 48th edition. I am 48 years old, so I was born and raised and weaned and bred on market cycles and seasonality and history. And we'll be putting out the 49th edition this year, which will be for 2016. We'll put that out around May. A couple of books I put out recently, The Super Boom, which is I'll talk about that. I'll show you some charts on it a little bit later, but it's building on the forecast that Yale Hirsch, the founder of the Almanac, and my father made back in 1976 for the market to make this 500% move following the war and inflation. He made that prediction way before anyone else had the guts or inclination to become bullish, and even throughout the 80s when he stuck to it, the early 80s, and the market was looking scary again, he had t-shirts made up that said Dow 3420 on it, which was 6 times the low, the Dow's low in December of 4, and this 500% move transpired, and it was projected to happen in 1990. The S&P hit 500% in 90, but it was July 92 when the Dow did it. And then my little book of stock market cycles is sort of a more a quicker read, sort of a sophisticated book for dummies on all the different cycles and historical patterns that we track and have tracked over the years. Some of these strategies, that we use all the time have shown up in some accolades. I'm sort of humbled by this Hulbert rating, where we were included in the top 5 market timers over the past decade. This came out last fall, showing a pretty low level of risk and a decent market timing performance. That's just using our 6-month switching strategy, the best 6 months. And you can see that the forecast I have there was for 19,000. That's still where we think we're going to get on the first half for the Dow. So the keys to market cycles. First, you have to identify the seasonality, the cycle, or the pattern. And then you have to anticipate and analyze the setup of it using some technical and fundamental alignment, seeing where things are happening. Oil, for an example, where you have this sort of technical and fundamental sell-off during a seasonal low period right here in the December to February area. And then you execute the trading with technical indicators, technical analysis and indicators. I overheard the previous presenter talking about some of their Genesis indicators. I use the Trade Navigator software as well. There's a lot of nice canned indicators in there that I like. And you have to have a discipline. You got to stick with what works. It may not be the same thing for all of us. It usually is not. But once you find things, you stick with it. You have to keep reevaluating as it may change a bit. We've seen some indicators become less effective. I just put out a research report to our subscribers just before I got on the call, where the sentiment indicators have not proven to be very effective. Those contrary indicators, whether it's put call, I look at investors' intelligence, bullish and bearish percentages. So it seems that that's not very effective and not giving us a lot of indication. The last time put call spiked to over 1, that's equity only put call, was November 2008. So sometimes there are periods of time where you have to realize that your trending indicators may no longer be trending anymore, and the oscillating or contrary indicators may be trending, and I think that's what's going on here with the 24/7 news cycle. The fact that everyone's sentiment is posted on Twitter right away instead of waiting for the mail to deliver, and Barron's or the other news reporters to consolidate, or investors' intelligence to consolidate all of the recordings or all of the sentiment readings from myself and others and send it out there. So things do change. So our process is we look for a cycle, a seasonality, or recurring pattern that we can capitalize on. We look at current trends and the economy, monetary and government policy, market internals and sentiment. I just talked about sentiment a little bit, advanced decline and new highs and new lows, volume, very simple, straightforward, and still effective. And of course, there's fundamentals and old-fashioned technical analysis and some new-fashioned stuff. There's a lot of interesting indicators out there that you can use. I like MACD in conjunction with relative strength and some stochastics. I look at pivot points as well, support and resistance levels, moving averages. Some people think that's too much. I get a nice picture by looking at a chart with all those different things on there for me. So the major investment cycles that we track: war and peace in the markets. This is the basis for that 500% move that follows war and inflation, the super boom forecast that I made, secular bull and bear markets. The decennial cycle, we've got the 5th year of the decade being the best. We finally had a loss in the Dow in 2005 after a 12-0 record starting in 1895. We go back before that, 1885. We have the 4-year presidential election stock market cycle. The pre-election year, no losses for the Dow since 1939. We've had some improved gains there, which you'll see is about average of 16% for the Dow in these years, though it's a bit softer when you have a second-term president. The seasonal cycles. Everyone knows the phrase "sell in May and go away," and the British or English of you might know the other half where that comes from. It's an old British saw, come on back on St. Leger's Day, which I'll explain a little bit more. That's a horse race that happens in mid-December, September in England. And there's lots of sector and commodity seasonal patterns that we use. I mentioned oil before. That's something that we're looking at right now. And then there's the quarterly, monthly, weekly, daily, and intraday patterns that we track. I'm not going to get into that too much, but one of the things that I find fascinating is with the intraday patterns that we track on the back of the Stock Traders Almanac, simply using the half-hourly closes for the Dow Jones Industrials, showing over the years the intraday behavior of investors and traders. And there's been a lot of chatter about high-frequency trading and how it's impacting the market. And, you know, when they got rid of the market makers and they went to pennies, it made things a little bit less easy to shave points on the market and make money, you know, making markets. But you can always use a limit to get into something and not get you know, taken advantage of by some sort of algorithm or high-speed, high-frequency trade. But the amazing thing is that these intraday patterns continue to prevail, where you see, you know, dips at the 2:30 period in the afternoon and Eastern time, and then you see that rally to the close, weakness early in the morning and around lunchtime. It's very interesting that the actual daily routines of the human being manifesting itself in the behavior of the stock market. And the January indicators, which were not very positive this year, though some of that may not be as important as it has been in other years. So in play now, we have the secular bear that's still on. I know that a lot of people think we've begun the new secular bull market. I still contend that we're going to have a sort of 1982 type moment or a 1949 type moment, and I'll show you some charts of that in a little bit, where, you know, we don't make new lows, but that sort of third low of the long secular bear market that we've seen is higher than the other two lows. We've seen that before. We think that this next big bull market and the boom that I've written about will begin soon. I mean, in the next few years. My window is the 2017 to 2018 period, after we get another you know, garden variety bear market, which we haven't had in a while. I suspect that may, you know, even begin in earnest later this year, in the middle of this year. Might not realize it until we look back on it with some hindsight, but sometime between you know, the next couple of years, I expect an old-fashioned regular bear market. We're still in that 4-year cycle sweet spot, and in the 7th year of a presidential term, which is less strong than the 3rd year. This is sort of the second third year, if you will. So we're looking at some positive action there. There's been an average of a 50% move off the midterm bottom. We think that's going to be a little bit softer this time around. we're in the midst of the best 6 months. We had our MACD buy signal on October 21st. Most stock sectors are in play now. Energy stocks and oil and gas are coming in right now in February. We're not in the business of fighting the Fed or the tape. We had a Santa Claus rally that was not around. We did get a first 5 days up move. The January barometer came in negative. And the one thing that's been holding with these early year indicators is this December low indicator, where the Dow has not closed below its December closing low so far in the first quarter. So let's take a look at the pre-election year cyclical tendencies. Another quotation that we have in the almanac that I think illustrates the presence of the 4-year cycle and also seasonality is from Richard Nixon in 1960. He says early in March, Dr. Burns called on him, that's Arthur Burns, became the chairman of the Fed for a little while there. Burns' conclusion was that unless some decisive action was taken, and taken soon, we were headed for another economic dip that would hit its low point in October just before the elections. You can see the plotting of the president to manipulate the economy to stay in power. Here's the sweet spot that I showed you. See if I can grab a little tool here to highlight, but it's pretty highlighted right here. You see that we've broken out by election cycle year and by quarter, and you can see that the midterm year has generally been weak, with the Dow averaging losses through Q2 and Q3, S&P loss and weak, NASDAQ kind of weak, and then I've highlighted in sort of the brown with the beige numbers the sweet spot of the 4-year cycle, which is the fourth quarter and the first 2 quarters of the pre-election year, where the 3-quarter combination averages 21.5%, 22 for the S&P, and 34 for the NASDAQ. However, so far, this combination, these 2 quarters have been subpar. They've been in the sort of 4% range. So that indicates to me that we might not be getting as much lift from the sweet spot. You know, this did transpire the last time around. We got about 15% or so, 16% in 2011. Q2, Q3 was less negative. So some of this positivity may have been pulled forward with, you know, all of the stimulus that we had in the prior year. The 50% gain off the midterm low, you know, the real significant thing here is that these highs, that the bulk, the cluster of the highs in the midterm year have occurred in December, and 6 of them occurred on the last trading day of the year. So just something to be aware of. We think that we're probably going to get something more in the 20 to 30% move off of the you know, February 14 low. We're up about 16, 17% since then. Maybe another 10 or so, you know, from that level. But because it's this 7th year of the 4-year cycle, you know, the second 4-year cycle for this president, it's a bit softer. So I'm not expecting as much, and we've had such a large amount of gains over the past several years, and the market's looking rich by many metrics. So one of the things that people like to think, you know, is that a Republican president is better for the stock market than a Democratic president. Really turns out to be that Republican Congresses have presided over the greater market gains. That remains to be seen here with this Congress. I think this is a very contentious political environment. It may change in a couple of years when a new president comes in if the Congress stays the same, but the greatest combination, which is what we have right now, is a Democratic president and a Republican Congress. But you can see the Republican Congresses have a gain of about 16.8% alone on average for the Dow. So another positive for, you know, 2015 moving forward. Again, not a loss in the 3rd year for the Dow since 1939. We've seen an average of 16% gain in the pre-election year. post-election years and midterms have gotten a little bit better. Election years have been a lot rougher. One of the reasons I'm concerned about next year, especially with a heated battle for the White House, more likely right now. But the past several election years have been rather weak and some quite negative. If you can remember 2008 pretty carefully, and 2000 was no prize either. So it seems to be a shift in cycle here where while the third year stays very strong, election years have weakened, and something we're concerned about for 2016. But right now everything seems to be on pace for further gains. And as I mentioned, the 7th year of the president's term, the second pre-election year, shows a bit of weakness. You can see 1987's crash right here, quite significant in the black line. And the blue line is all pre-election years. The black line is just the 7 years. Now, it's not necessarily the greatest statistical sampling. There's about 6 prior two-term presidents in the last century that are in this chart since 1901, 1930 for the S&P here. So you don't have a whole lot of statistical examples. However, there is something to the fact that people are a little bit disenchanted with the current person in office. So this year, Santa didn't really come to Wall Street, and January was down. Not a great indication for the market. An old saying that we have in the almanac, created by my songwriting father, Hirsch, is that if Santa Claus should fail to call, bears may come to Broaden Wall. And I've highlighted the last several Santa Claus rallies going back to last year. We had the last 4 losses, followed by a pretty serious bear market in 08, a bear market in 2000, which continued on, but had a good chunk of the loss, and the other 2 years were kind of flat. So not a great indication when this usually bullish period of time where the S&P averages about 1.5% during the last 5 days in the year and the first 2 of the new year. When it doesn't happen, it's a negative indication. And we've been having some better readings from a combination of all of the early year indicators, the first 5 days, which is the FFD, the January barometer, and the Santa Claus rally. So we've only seen 4 prior times when we had 3 prior times when we had a negative Santa Claus rally and a positive first 5 days. And this is the first time where we've had a negative January barometer followed up. So it's not a great indication for this year, but I think we've been seeing a shift where there's a greater deal of profit taking in January. There's an old, saying or saw in the commodity pits, the S&P pits. They're always looking for that January break. I think that January break that is known in the S&P futures pits is now presenting itself in the cash index quite more prevalently in recent years. We've seen January take a lot of hits, and I think there's been a lot of profit taking where people are pushing their tax implications and their profits taking into the month of January. Then there's this December low indicator, which was something that Lucian Hooper, an old financial reporter, used to write about in the 70s. It was brought to our attention by Jeff Sautt of Raymond James, actually a broker we know down there. Dave Cam had shared that with us in one of Jeff's research reports many years ago. So this is the line in the sand. The Dow's December closing low of 17,069 roughly. If it closes below that before the end of March, it's the watch out warning. That's a support level. The low of the previous December has proven to be, a line in the sand. And in conjunction with the January barometer being negative, if it crosses that, I would suggest that it's something to be rather concerned about, and that we should be looking towards our fundamental indicators and technicals for what's going on in the near term. So our outlook for 2015, we put out a forecast every December. As I mentioned earlier, looking for Dow 19,000. This is a little clip. Don't expect you to take all this in, but I wanted to just show you what we do on a monthly, bi-monthly basis, and something we're looking at all the time is these 5 areas: psychological, fundamental, technical, monetary, and seasonal. I think people hear about the almanac and what we do, and it's like, oh, seasonalities, it's just it doesn't matter. It's a fallacy, and some people are fundamentalists and they don't think technical analysis means anything. Technical analysts will say, nothing matters but price and volume move. I tend to think it's a combination of all of it. So a lot of times we'll start our analysis from a seasonal perspective and dig deeper, with fundamentals and technicals. And in the case of oil, which I'll keep talking about right now because it's important and it's what's happening. You have this convergence of a seasonal low in conjunction with a technical and fundamental breakdown and low, and a supporting bottom point there. So we're buying oil right now, and I think that is a way to show combining all these different disciplines or indications. So our current outlook, I think there's been a pretty broad mix of positive and negative data points and indicators out there, or news. The market was quite jittery for a while, and now it is leaking higher. The action in January was disconcerting, but we are not rushing for the exits. Support did hold. It was down, 5% or so in January. It felt like a lot more, but it really wasn't that big of a move. The news shows seemed to pump it up quite a bit, but it was a little 5% correction. In fact, a bit less in several of the indices. We have this weaker pre-election year. I don't think we're getting a bear market right now, probably sometime in the next few years. Perhaps might begin later this year. GDP seems to be back on track. Earnings were a bit better than the headline stocks. Some of the big names were down, but there seemed to be quite a lot of good companies, meeting or beating and doing well in their quarterly reports. The economy seems quite okay. We've got the December closing low still holding up. We haven't seen any, major technical and fundamental or macro breakdowns is what we're looking for. This, end of QE seems to be digested quite well, and all these recent dovish remarks, again, are supporting our view that the market's going to be leaking higher. Some concern with the dollar. It was quite undervalued. It has now gone to fairly valued, or something that the U.S. was benefiting from. We might be benefiting to take a European vacation right now, but the strength in the dollar is a little bit of a drag or a weight on the U.S. market and economy. Equities are by far no longer cheap. They are quite rich by many metrics. And our forecast, just to be clear, is for a move up to Dow 19,000, maybe in the next month or so, and 2250 on the S&P or thereabouts, and Nasdaq 5,000 is right there. And after that, I think we might get a little sideways move, be an opportunity to either take some defensive action in the worst 6 months, or even the old technique of writing covered calls against your longs. But even so, at that point, when we put out our sell signal, I'll be advising people to be more cautious, tighten up stops, sell losers, and go easy on getting into new heavy long positions. So what's next? Interesting chart came across my desk, my screen a while back. Was sort of something sort of promotional for an advisor, a fund company. They said, here, use this chart, look at these 2 moves, something to start a discussion. So I looked at it. They show the move from 94 through 2000, 200% drop down of 49%, up 100%, down 15%, down 57%. There are, to me, it was an implication that because we're up 200% here, we're going to get another one of these big moves down. But I look back and, in my historical mind, thinking about the past secular bear markets, secular markets, that, this doesn't necessarily gel with me. That I don't believe that, and by looking past, into the past, that, a move of greater magnitude does not beget a down move of greater magnitude. So here we're looking at the 60s, 70s, and 80s, just to show you that, 82 bottom I had talked about. You had a big move up of 100%, down 36%. Only up 74% from 1970 to 73, down 48%. The big middle bear market of the secular, middle cyclical bear market of the big secular bear market. Then we had another move up 126% to the top at 80, but only a 27% drop. And you can see how we went higher than the previous high before the end of the what's now declared the end of the secular bear market, the beginning of the secular bull market on August 12, 1982. Looking back into the previous era, the Depression, 1932, up 300%, down 54%. And this is after the crash. We had a sort of more of a sawtooth move here, up 60%, down 46, up 58, down 30. Again, we take off for the secular bull market of the 50s and 60s. This one sort of lined up a little bit more top to top. Just a perfect example of how history rhymes and doesn't repeat. And we can't just proclaim that because we broke out above this top that we're still not in that long-term secular bear market. This is the basis for the super boom forecast, these 500% moves that follow war and inflation. My friend Josh Brown, the reform broker, called this his favorite chart on earth, or the greatest chart on earth, something that Yale had drawn more with pen and pencil on top of a stock chart back in '76 when he made this forecast, which ended up being part of a January 1977 special report. We've gone ahead and used the more modern software techniques and drawn some things on here. But I highlight the, secular bear market of World War I, World War II, and Vietnam. You see inflation as measured by the CPI running up during these wars, 5% move. Big inflation move in the 70s. You see sort of these like 1, 2, 3 bottoms here, 1, 2, 3, not exactly the same, but they stay in these sort of ranges here. You have, 1970, 74, 82. Here we have 2002, and we have 2009, and what are we going to get over here? So we've put it in here some of the different events that sort of signal the beginnings and ends of things. Just to give you an idea of how this is pinning out. Inflation here is a different animal, probably more in the World War II area. Right now we're only up about 30 or so % from 2001 when the 9/11 happened. So when we put out this forecast using this historical pattern that Yale had come up with, we put out a projection that went out with some of the promotion stuff for the book. And just to be totally clear about everything, I kept track of what my initial forecast was. So back in March, end of March, beginning of April 2011, when this forecast came out, I drew this blue line as a projection for where the market would go, or that I thought it might go going forward. And I thought that using the 4-year cycles and the seasonalities and everything I could summon together to make such a I think the word is fakakta forecast. Any of you remember that from the Blues Brothers or know a little Yiddish? Kind of a not necessarily you go out on a limb here with this. So the blue line represents where I thought things might happen back then. January 2014, after seeing it break away from where we had thought it sort of tracked it for quite a while. Then, QE2, QE3, the Fed keeps fueling the market higher. Okay, we're probably not going to get that pullback. The red line comes in, the forecast I made back in January. And then as we see it sort of separate from that forecast again, we reevaluate. And currently, the green line shows us where I think we might go. We currently have, this is at about 18,000, so we've gone up a little bit higher than that. Maybe we'll get up to about 19 here, where I think we are, before we start to roll over. And perhaps we won't get as low as 12,000, but just to give you an idea of the general direction, I'm expecting, now that we're out of Afghanistan and inflation may start to pick up, or even if it doesn't a whole lot, it's still more than people even imagine. I mean, right now it's been negative the last couple of years, but going back to 2001, inflation has picked up quite a bit. So we're looking for a low point somewhere, the last cyclical bear market of this secular bear to begin the next liftoff to the 500% move, and there's going to be some things that have to start for this to come to fruition. So you can look into more of that later. I just wanted to give you that sort of long-term outlook. But let's look at some seasonal sector trading setups just before we try to wrap this up, show you some of the things we're looking at right now. The best 6-month switching strategy is the only proven black box system out there that we've know of. We've had it tested by scientific people, and the people that put out a book testing 6,000 other systems found this one to disprove the null hypothesis and have predictive value. We go long and short at different times of the year. In October or so, we get kind of long, we get aggressive. We use MACD and other technical indicators, and there's a lot of different things that can use. So I see my time starting to run out. Let me just jump forward here. This is built based on this seasonal pattern where we see weakness from May through October. A little bit more strength is picked up in July and October in recent years, but we still have some weakness as we had this year in the September-October period this past year. See the strength in November, December, January, and March and April. It creates our best 6-month switching strategy. Here's a wonderful pattern, I think, that shows the flip in time. This blue line on the bottom here is 1901 through 1949. You can see there was almost buy in May back in the old days when there was a farming society and a lot of economic activity and cash flow was generated by the the economy's basis on farming and equipment and fuel and hiring. And you can see from 1950 to 2013, you get sort of sideways, nowhere's moved from May through October. Even since 87 in the red line, the pattern still holds. You can see that the gains in the best 6 months of November through April outperformed the worst 6 months. A $10,000 investment, just hypothetically compounded, turns into $674,000, whereas you lose $1,100 in the worst 6 months. Add in that MACD timing. We use 12.26.9 on the sell and 8.17.9 on the buy. Turns that increases those returns to 9.3, creates a loss of 1.2, and then almost triples that $10,000 the 600 some odd thousand to almost $2 million, and the loss expands to about $6,700. Here's a look at our buy signal here. You can see the crossover of the 8.17.9 in October. We get in right here. We had a sell signal back in the previous April. The Dow was up about 2.3% during that time frame, and here we are up a little bit further here. Now we're up probably closer to 8%. We're up here at 8,000. So you can see the effect of this. Recent pattern, recent results. We had a pretty great worst 6 months in 09 after we had that bottom, but since then we've seen the best 6 months average about 11% in the Dow and the S&P, and pretty much flat, with a pretty bad year and a decent year in there, since 09. So oil comes into play here. This is the oil stock index. Tends to bottom in December, runs through to June, July. We see that the seasonal pattern was coming down quite a bit here into right into the normal seasonal low that you see right here. So it's kind of tracking that well. This is that seasonal setup here. So something we had traded a little bit of the XLE for a while. I don't particularly own that one right now. It's a bit higher than it is on this chart right here, but you can see it's sort of we had got in there about 76.15 and we had traded out of it ourselves. It's still in our newsletter subscriber, hypothetical portfolio, but we don't currently hold that one. The crude bottom is something that's even more dramatic here. We can see this low point forming here, right in with the low in the seasonal trend. This is sort of the beginning of the ramp up with, getting ready for the summer driving season, and they sort of changed some of the inflows into the refineries, again, in conjunction with the, macro seasonal, macro fundamental decline we had and a technical breakdown. So the stock that we like and we own, it's an ETF, the USO, which trades the commodities. We're in it right now at about, in the newsletter we got in here, I think we own it at an average price of about 19 in our portfolio. So I think we're off a couple of bucks on that right now. But we only have about a half position. We're going to be building that over the next month or so and looking to capitalize on this range. I think there's going to be a bounce. I put out a report that calls for about potentially $75 on oil. We get back up to that sort of range, a little bit higher than some people are thinking. Natural gas also forms a bottom in February. It's come down quite dramatically, so it's set up for that June. Runs into June. You get to pick up from the air conditioning season, where the utilities start buying up a lot of gas to make electricity for air conditioning. So you can get into the First Trust Natural Gas, which is the stocks that move it and create it, explore for it, and produce it. And the UNG, which is one we own. Also, we have a stop in here at 13.12. But this is another way to trade the seasonal pattern. This trades the commodities. It's a great ETF for investing in natural gas. So I think I'm about out of time. I was going to give you some highlights on the probabilities fund. Again, as I said, it's averaged about 154% to 63% for the S&P from 2008 to 2014. You can look it up on Morningstar. It's tracked and traded everywhere. They're using a lot of the probabilities and strategies that we use in the Almanac to find the best times of the market, the best times to be in the market, and the best times to be out, using inverse ETFs on the outside. There's a quick shot of their track record. If anyone's going to be in New York, you can come see me at the Traders Expo this weekend and talk more about this. Again, if you want to stay at 20% on our subscription service and get all these different trade ideas on a regular basis, go to stocktradersalmanac.com and hit subscribe now and use the code FRIGID20. And I'll leave it right there and say thank you for everyone. And I don't know if there's any time for any questions. If anybody has any, I think there was a couple back there. I can't see if I can see those.
Yo, I think we have about a minute left for questions. So if you want to knock one or two of them out, that'd be cool.
Okay, let me see if I can make this bigger here. So I would have thought start with fundamentals, then seasonals and technicals. If you're more fundamentally based, yeah, I mean, there are times when we do start with fundamentals, but we sort of look for the times of year when things are supposed to be bottoming and topping, and then look at them, a little bit more deeply, fundamentally, technically. The gas symbol, the other one was UNG. FCG was the ticker for the ETF that is based on the stocks and companies that trade, that explore, produce, and distribute natural gas. Do you think wood has hit bottom? I don't know. Oil, I think oil has hit bottom, if you're asking about that. How well does the Almanac perform to actual results? I mean, we've done quite well with it. We're up about 10-11% in our portfolio since April using all these strategies. So, and the probabilities fund itself, you can see their numbers that I just showed you, shows that those strategies work. You have to stick to them and execute them, though. Swap hair treatment for stocks. That's so funny. Somebody else put a tweet out on that. It must be Phil. Is that Phil Perlman out there? Yes. Okay, great. Thank you very much. I think I'll leave it there. And again, if you have anything else you want to find out, go to StockTradersAlmanac.com. You can email me from there. My contact us has my information on there. So again, let me know. Maybe I'll see some of you in New York City or elsewhere.